Hello everyone. In this module, we study Chapter 5, Analysis of Financial Statements. The learning objectives include how financial ratio analysis help managers assess the firm's health, compute profitability, liquidity, debt, asset activity, and market value ratios, compare financial information over time and among companies. Profitability ratios. Gross profit margin equals to gross profit divided by sales. It measures how effective is the firm at generating revenue in excess of its cost of goods sold. Operating profit margin is operating income divided by sales. It measures how effective is the firm in keeping cost of production low. Net profit margin is net income divided by sales. It measures how much net profit is being generated from each dollar of sales. Return on assets is net income divided by total assets. It measures how effectively is the firm generating net income from its assets. Return on equity is net income divided by common equity. It measures how well is the firm generating returns to its equity providers. Liquidity ratios. It measures the ability of the firm to meet its short-term financial obligations. Current ratio is current asset divided by current liability. It measures are there sufficient current asset to pay off current liability. What is the cushion of safety? Quick ratio is current assets minus inventory divided by current liability. It measures what happens to the firm's ability to repay current liabilities after what is usually the least liquid of current asset is subtracted. Debt ratios measures the relative size of the firm's debt load and the firm's ability to pay off the debt. Debt ratio equals total debt divided by total assets. It measures what portion of the firm's asset is financed with debt. Debt to equity ratio is total debt divided by common equity. It measures what is the proportion of debt relative to equity financing for the firm. Times interest earned ratio is operating income divided by interest expenses. It measures what is the firm's ability to repay interest payments from its operating income. Asset activity ratio helps assess how effectively the firm is using assets to generate sales. Average collection period is accounts receivable divided by average daily credit sales. It measures how long does it take for the firm on average to collect its credit sales from customers. Inventory turnover ratio equals sales divided by inventory. It measures is inventory effectively translating into sales for the firm. Fixed asset turnover ratio equals to sales divided by net fixed assets. It measures how effective is the firm in using its fixed assets to help generate sales. Total asset turnover ratio equals sales divided by total assets. It measures how effective is the firm in using its overall assets to generate sales. Market value ratios. Price to earnings ratio is market price per share divided by earnings per share. It measures how much are investors willing to pay per dollar of earnings of the firm. Market to book ratio is market price per share divided by book value per share. It measures how much are investors willing to pay per dollar of a book share. EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's often of great interest to financial analysts. It measures the amount of cash thrown off from the operations of the company. Economic value added, EVA. EVA is the amount of profit earned after all costs have been subtracted, including the cost of funds used for the investment. It's often seen as the measure of true economic profit. Market value added, MVA. MVA is the market value of the firm, debt plus equity, minus the total amount of capital invested in the firm. A firm that consistently invested in high EVA projects would have a high MVA. Relationships among ratios, the DuPont system. Return on assets equals to net profit margin times total asset turnover. The modified DuPont equation, return on equity equals net profit margin times total asset turnover times equity multiplier.